welcome to this explainer. Today, we're going on a seriously eye-opening journey to decode some of the biggest financial mysteries out there. Because honestly, the economy isn't just a bunch of random, boring numbers on a spreadsheet. It's actually a direct reflection of human behavior, our choices, and trust. We've got a ton of ground to cover today, so let's break this down step by step and finally expose the invisible forces pulling the strings of the economy.
Okay, let's dive right into a foundational question that pretty much everyone thinks about but rarely says out loud. Why on earth is the financial world so incredibly intimidating? Well, part of it is because the language of money is often deliberately complex. But at its absolute core, money is just a tool. It's a system of exchange that we've all just collectively agreed upon. And I promise, once you understand the basic mechanics, all that confusion just kind of melts away. So, let's start our journey with the paper in your wallet and explore the illusion of currency value.
Think about it. A dollar, a pound, a yen, they're all basically just pieces of paper, or, digits on an app. So why isn't $1 worth the exact same as 1 pound or 1 yen? Honestly, sometimes it feels like someone just threw a dart at a board to pick what these currencies should be worth. But the value isn't about the ink or the symbol. It actually represents the strength, the productivity, and most importantly, the global trust in the country that issues it. It turns out a currency is essentially a live scoreboard for a country's economy. On one side, you've got strong currencies fueled by economic growth and high investor trust. On the other, weak currencies, usually dragged down by job losses and struggling economies. Let's look at a real-life example. If Japan sells more products to America than America sells to Japan, the demand for the yen goes up. Why? Because American companies literally need yen to pay their Japanese suppliers. It's a highly active marketplace where these currencies are just constantly competing. Now, this leads us to a question we've all asked. Why can't the government just print more money to solve our problems? Well, imagine your town has 100 people and exactly 100 loaves of bread. Everyone has $10 and each loaf costs $10. Perfect, right? But if the government suddenly prints an extra $1,000 and just hands it out, you don't actually get richer. There's still only 100 loaves of bread. People rush to the store, the baker realizes he can charge way more, and suddenly, boom, the price of bread jumps from $10 to $30. More money is simply chasing the exact same supply. Let's take a quick look at history to see how this can snowball into total currency collapse. Take Germany in 1923. Early in the year, grocery prices were totally normal, but by mid-year, shoppers were literally pushing wheelbarrows full of bills just to buy basic daily supplies. And by late 1923, a single loaf of bread cost billions of marks. Literally billions. Printing money without actual economic growth turned their cash into worthless wallpaper. But what about the flip side? What if prices actually go down? Falling prices sound like an absolute dream, right? Cheaper rent, cheaper groceries, but deflation is actually a massively dangerous trap. Think about it. If you know a car will be cheaper next month, you're going to wait to buy it. And when everyone waits, businesses notice the drop in sales and cut prices even further. Then they lose revenue. They start laying off workers, and people have less money, so they spend even less. The whole economic engine just freezes. This is exactly what Japan experienced in the 1990s, when their economy stagnated for decades. So, the absolutely crucial takeaway here is perfectly captured in this idea. The actual number on the bill means nothing. What matters is the economy standing behind it. You literally cannot just print wealth. You can only print inflation. Money represents actual work, resources, and productivity. All right, let's zoom out a bit and tackle our second section, global debt and the reality of tariffs. Everyone knows America is in debt, to the tune of about $36 trillion. But who exactly are they paying back? They don't just owe one giant global bank. They owe a massive web of lenders. We're talking about their own American citizens holding savings bonds. We're talking foreign nations like China and Japan holding treasury bonds. They even owe pension funds that manage everyday retirement accounts. Countries lend to each other constantly because these bonds are essentially IOUs that are viewed as very safe interest-paying investments. As long as the economy keeps growing and trust remains, the whole system just keeps humming along. And understanding this interconnectedness perfectly busts a major myth about tariffs. When a government slaps a 25% tariff on, say, $1,000 of imported Chinese steel, it sounds like China is writing a fat check to America, right? But the foreign country doesn't pay a single cent. Here's what really happens. The U.S. importer pays that extra $250 tax at the border. Then, that US company isn't just going to eat the loss, so they raise the prices on the cars and appliances they build with that steel. And finally, you, the consumer, end up paying the inflated final price. So here is your reality check. Tariffs are simply taxes on imports, and taxes almost always get passed straight down the chain to the end user. The foreign countries aren't footing the bill. That extra cost just quietly sneaks right into your shopping cart. Global economies are entirely interconnected. Debt is a massive web of IOUs, and trade penalties are ultimately paid by everyday shoppers just like you and me. Now let's bring things a little closer to home and look at housing and market mentalities. The numbers we're looking at here are just staggering. 50 years ago, a single middle-class income could easily buy a house, grab groceries, and still put money into savings. Back in 1970, adjusted for inflation, an average home cost around $170,000. Today, we're looking at over $400,000, while wages have practically crawled forward. Why the huge jump? Well, it's a mix of restricted housing supply through zoning laws, a growing population, and crucially, Wall Street investors treating residential homes like stocks to flip or rent. Because of this, the cost of basic shelter has become this massive, unbridgeable chasm for so many everyday people. And speaking of treating things like stocks, whether it's housing or the actual stock market, you really need to know the difference between trading and investing, because they demand completely different mindsets. Trading, that's a fast, highly volatile sprint. You're betting on short-term momentum, constantly staring at charts. And honestly, most traders lose money trying to time the market perfectly. Investing, however, is a long marathon. This is the Warren Buffett method, patiently buying quality companies, waiting out the inevitable crashes, and letting compound interest do all the heavy lifting over decades. The big takeaway for this section is wrapped up in this somewhat heartbreaking reality. Homes were once places to build a life. Now they're assets in a portfolio. Everyday necessities have completely transformed into financial assets, pricing out the very people who need shelter the most, while heavily rewarding those who already own property. So if traditional money and assets are so flawed, let's explore the alternative in Section 4, the digital money frontier. Let's take a second to demystify Bitcoin. First off, it is not a physical coin hiding in a shiny vault somewhere. It's literally just code. It operates on a public blockchain ledger that records every single transaction. When you send Bitcoin, thousands of computers around the world, called nodes, verify your transaction by solving incredibly complex math problems. There's no central government, no big bank controlling it, and your identity stays totally hidden behind a long string of numbers and letters. Now, the reason you hear people calling Bitcoin digital gold is because absolute scarcity is hard-coded right into the system. There will only ever be 21 million Bitcoins in existence. That's it, period. Which means no government can step in and arbitrarily run the printing press to create more, completely avoiding that crazy bread inflation we talked about earlier. Of course, it is definitely not perfect. It's highly volatile, transactions can be painfully slow, and hey, if you lose your password, there is absolutely no customer service reset button. Your money is just gone forever. But the core takeaway here is profound. Bitcoin actually proves that you can create a working currency through pure math, rather than relying on trust in a government. It represents a totally radical shift in how we fundamentally define value. For our final stop, Section 5, we're going to look at the shadowy side of finance and see how the wealthy actually bend the rules. For most of us, debt is a bad word. It means high-interest credit cards that just drag you down. But for the ultra-wealthy, debt is a superpower. Imagine you have $10 million sitting in stock. If you sell that stock to buy a mansion, the government's going to swoop in and take millions in capital gains tax. So what do the wealthy do instead? They borrow $2 million in cash against their stock at a super tiny interest rate, like 3%. Meanwhile, their stock portfolio continues to grow at, say, 10% a year. They get millions in cash to spend, their assets keep growing way faster than the interest they owe, and because they never actually sold anything, they pay exactly $0 in capital gains tax. It's wild, right? They literally use debt to get even richer. And if we step completely outside legal loopholes and look at outright criminals, they exploit the massive, complex size of the global financial system. Look at the classic three-step money laundering process. First, placement, breaking up dirty cash into small, unsuspicious deposits to sneak it into the banking system.
Second, layering, moving those funds through a dizzying maze of global offshore accounts to bury the paper trail. And finally, integration, investing that now hidden money into a totally legal business, like a restaurant or a car wash, so the money returns to them as clean, taxable profit. It really proves that money laundering isn't just about hiding cash, it's about hiding the crime right inside the daily noise of millions of global transactions.
Wow. Okay, we have covered a massive amount of ground in this explainer. We've busted the myths of currency value, we've shown how tariffs and global debt impact your daily life, and we've revealed exactly how assets, algorithms, and the ultra wealthy manipulate the system. So, I want to leave you with one final provocative thought. Now that you can clearly see the invisible forces, the math, the trust, and the leverage pulling the strings of the global economy, how will you use this knowledge to navigate your own financial future? Think about it. Thanks so much for joining me on this journey, and I'll catch you next time.